We run a sector scorecard that actually relative ranks all 11 sectors of the S&P 500 on a combination of technical and fundamental factors. And sequentially over the course of the last year, we've been seeing the sector scorecard get more and more aggressive. The last time we ran it in November, the top 3 sectors were financials, industrials, and materials, so a very strong cyclical tilt. And the bottom 3 sectors are utilities, consumer staples, and real estate. So it's definitely giving us a signal of stay aggressive, stay cyclically tilted for 2021, at least here at the start, and generally underweight those defensive sectors that are naturally going to lag as the markets recover to anticipate economic recovery over the course of the year. In terms of the global equity market outlook, our global scorecards are pointing pretty strongly towards emerging markets as having a banner year in 2021. This is the first year since 2018 that emerging markets have really popped up toward the top of our relative ranking methodology. Most of that is because of emerging markets' sort of natural position in the lead when risk tolerance emerges. Coming out of major recessions, we see risk tolerance start to emerge, and that tends to benefit the emerging shares given that they're risky areas of the globe. But also the dollar breakdown is really key. The emerging market equity shares are very closely correlated to the dollar. So as the dollar weakens, it improves the relative outlook for emerging market equities. Our work has pointed towards small caps really since April of last year. April 2020, we saw a very strong backstop put in by the Fed for small cap shares. What we've historically seen is when the Fed expands the balance sheet or eases policy, just like in 2009, they did that in 2020, that tends to benefit small caps. Then we started to see small caps accumulate even more evidence of likely outperformance in the form of an earnings rebound, a revenue rebound. Over the course of 2021, we anticipate that small cap revenues should outpace large cap revenues for the first time since 2017. This should help elevate small cap performance and keep this group atop the rankings when it comes to market caps. We don't actually have year-end targets for our markets, but we do run fair value models. And these fair value models give us a reasonable expectation of what to expect for stocks over the course of the next 12 months. Currently, we're anticipating still persistently low interest rates, but nonetheless, interest rates inching a little bit higher, really tight credit spreads to maintain throughout 2021, particularly relative to the blowout in credit spreads that we saw in 2020. And an earnings recovery to emerge over the course of 2021 and 2022. Those factors together combine in our fair value model to suggest that as long as we see double-digit earnings growth, we should continue to see prices rise for the S&P 500. The upside target for us right now is 4,000 based upon the idea that PEs remain well supported by those interest rates. And as long as earnings can recover to the degree that analysts are anticipating, 4,000 seems easily within reach for the S&P. Our commodity strategist at Bloomberg Intelligence is actually quite optimistic about the outlook for all commodity prices, but in particular precious metals. He doesn't necessarily produce a price target for gold, but does actually see gold outperforming equities. Contrary to my view that stocks should continue to perform well in 2021, our commodity strategist thinks that gold is the place to be.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.